my jam, I feel good.
You drinking chocolate milk over there?
No, so this is coconut water with a culotta poured into it, which is Cuban for espresso. JC, correct me if I'm wrong. And
Something like that.
Cream. Better than any iced coffee you'll ever have.
Okay.
Kids these days, Thrasher, you never know what they're drinking.
Coconut milk.
Was that a coconut? Oh, he's got a real coconut. Oh, this asshole.
Yeah,
We get it. We get it. You're in the Keys. We get
don't
it.
drink that shit from Whole Foods.
Not all of us can go to our backyard or coconut tree.
Yeah, tough luck.
These guys.
Sorry.
This is awesome.
Let me ask you something, Willie.
Willie can throw a rock and hit 12 breweries. Steve can throw a rock and hit 12 fruit trees.
Willie, talk to me about breath. Was something scaring you last week? Did I misinterpret that? Did you get rotation? Were you seeing some stuff that was good, some not?
Well, my point was a couple weeks ago we had started to see an expansion in the number of S&P 500 stocks making new highs. All of a sudden we had the index make new highs, and you didn't have the same number of individual issues making new highs. That was the, it's an observation kind of thing, not let's recalculate everything we're looking at. To Andrew's point, then, by the end of last week, if you looked in Barron's, the new high list for NYSE and NASDAQ had surged last week. And so, I don't know if it was a hiccup or it's a rotation. We aren't yet at the point where you've got massive numbers of individual stocks making new highs, but that's kind of been a recurring theme this entire cycle. So if we can get it moving in the right direction, that to me is probably good enough, especially given from a trend perspective, you're seeing more areas start to be in uptrends than you did in the past. Even if they're not at highs, they're at least trending higher. So that's, from my perspective, that's improvement. We actually today upgraded breadth from being neutral overall to being bullish overall. So,
what was the biggest driver in that, out of curiosity?
Yeah, the thing that made us do it today is we saw an expansion in the percentage of industry groups trending higher. It's something we look at on a weekly basis. When the charts are sent along, we started to see that expand. The thing that's had me hesitant to do that is the percentage of international markets above their 50-day moving averages had been strong and has pulled back a little bit. So I'd be more comfortable if we're not just seeing U.S. breadth improve, but also see that international breadth improve. But I think it's heading in the right direction. So I'm pretty comfortable where we are right now.
How do you feel, Willie, how do you feel about focusing on the 52-week high list when the indexes themselves, the S&P and the Dow, aren't even making new 52-week highs? What about like shorter time frames? I know we particularly like to focus on the 21-day, 63-day, and 126. Yeah. While the indexes are getting there, right?
Yeah, I think that's fair. And again, it's not like, is that new 52-week high list, is that a make or break for me? No, but what I had seen was improvement, and then it stopped improving, so that caught my attention. There's a chart shared by Strategas today talking about the number of 20-day new highs, higher than it has been, not back to where it was in June, but still, it's heading in the right direction, I think, is the thing we want to focus on.
When you look at some of the readings from June, do you guys think it's more important to be looking for like breadth thrusts? Because I think the percentage of S&P stocks that got overbought at the June highs was the highest since like 1991. And we're probably not going to hit that again. So there's going to be a divergence there, but is that bearish? If we have the highest,
I think a lot of people get caught up in that, especially a lot of newer traders where they expect that high watermark to always get taken out. You see that a lot, I think, in momentum too, to where if something has an RSI of like 89, it's a divergence if we're at 75. Like just because it's so I don't think you have to get always that high watermark. So when I look at like percent above moving averages, I think if you could have a divergence, but it's kind of where the divergence is happening. If you have the high watermark was like 90% of stocks were above their 50-day moving average, and we go back to if you get to 80%, Yes, it's not the same, but still 80% is a lot of stocks. So I think the bigger picture is the divergence happening closer to like 50 and 45, where it's diverging and you actually now have more stocks that are under, and kind of looking at it from that angle, that you don't always have to get back to that high watermark. I track a lot of thrusts. I have a thrust composite that I track, and we had a ton of different kind of ways you measure thrusts happen kind of in April. Some kind of happened in May and June. They kind of trickled in. Similar to when you're talking about like the 20-day high happened early and they happened again. And I think those are definitely encouraging signs. They kind of show that kind of that build up in buyer interest. But I don't think you have to re-hit those highs.
All right, Hurley, you're being awfully quiet over there.
I am. I'm just learning.
That's how Mike
things
looks
going
at
on
it.
between his ears that I want to know. Tell us how full of shit we all are. Where are we getting this wrong?
And let me answer and give you a couple points from the old guy who's been through a few market cycles. I think you're making a lot of good points, particularly Andrew, who talks about perspective. Market internals are the best tools in the world. They truly are the pulse and blood pressure of the market, but you cannot push them too hard. If you push them too hard, you're going to see a lot of things in the charts that are wrong. So I like to describe the market cycle like the seasons: fall, winter, spring, summer. And the best signal out there is to watch for a big, and this is in the charts that I hope are being shown right now. If you see a big flush in the new 52-week lows, that's a selling panic. And then if you watch for a big surge in the stocks above their 50-day, like 90%, you've had a cyclical bottom, right? A selling climax and a buying climax. It's what Lowry's talks about. That happens about every 3 years. You don't even look for divergences for about 2 years. As Andrew mentioned, a lot of people look for divergences too early. And if you look at the statistics, the number of new 52-week highs usually peaks the first year of a bull market. Again, the number of 52-week highs peaks in the first year of a bull market, and you have 2 more good years with potential divergences that drive everybody crazy. So the way I try and really gauge the cycle of the market is I wait for what I call the first fall day. And by the first fall day, I mean the first meaningful increase in new 52-week lows. And if you look at the chart we're showing, you had one in January of 2018. Remember, 2018 was a sideways year. It started with the worst January on record, but then the market crept higher into October before you had the high. Well, in that decline in January, new lows pegged about 600 or 800 negative. It was the first time they were negative in 2 years. Well, that's the first fall day, buddy. Once you have a fall day, then you start looking for divergences. And sure enough, when the market rallied in October, big divergence, plain as day. And then winter came. And when you had winter, you watched for the blowout. Same thing happened in the 2015 cycle. Again, you had a fall day. There were a lot of divergences before the fall day. But once you have that first surge in new 52-week lows, the first meaningful weakness, that's where Ari Wald usually finds a sector culprit, because usually one sector is coming undone, right? And you see it in the new 52-week low data. So you don't really worry about divergences the first year or two of a bull market. And so while you're talking about a lot of divergences right now, they don't matter, because you're your first year in a bull market and you got about 2 years to go. And you can see a lot of divergences and they're going to drive you crazy, but you need to be long, you need to be strong, you need to make money.
Hurley, you're the fucking man, dude. Let me ask you this. Let me be clear about something. That initial, like, I don't know, let's call it like a bearish thrust, right?
Yes,
I guess you would call it.
Good point.
The first fall. Can you define that a little bit more clearly for my slow thinking mind?
So yes and no. Like anything in technical analysis, it takes judgment, JC. Now, when you look at the chart that I've sent and you put it up here, and I put little fall day in quotes by it, you go, oh, of course, There it is. Now, is it 400? Is it 600? Is it 737? It could be. So there's no real rule, but the point is, during 2016 and 17, you could have seen a lot of divergences in there. And I did every week, and I would give a weekly brief to our team. And you got to ignore them until you see some meaningful weakness. And then when you see the meaningful weakness, then you start looking for real divergences. So yes, you can define it as a significant thrust in negative territory when there's been no thrust in negative territory prior.
I like that. No, I really like that a lot because it's almost like, it opens up. It's like living in Florida and it's now hurricane season. Like now is the time for these hurricanes to show up, not in March.
Right. And that's the market. You're in the first year of a bull market, dude. You're going to see a lot of divergences. And you know what? You're going to get excited to sell things and you're going to sell them too soon.
All right, Thrasher and Willie, where does Mike have it wrong?
I think I don't think he has it wrong. I think the other part of it is looking at time frame as well and looking for when you can have rotation. So I sent over a bunch, like some of the charts I sent over and looked at how financials are seeing expansion and breadth. Technology, I think, is starting to see kind of a contraction in breadth. And so you can have some where you have some looking at the sectors where you can see the rotation. And you're starting to see financials, industrials, they're picking up. Tech, like I said, tech is starting to have some of the weakness in the percent above moving averages. But then when you look at the whole overall market, S&P is starting to expand. NASDAQ, because it's basically just tech, is starting to kind of contract a little bit. And I don't think that has to be, not everything has to be a 2008, a 2000, or a pandemic March. That we don't have to see these explosive moves, that you can have some maybe contraction, you get a flush out, and we go back and continue to trade higher. So I think time frame is the other piece of it. And I think that gets really complicated, especially on social media where someone posts a chart and you can't always divulge and get into it because it's the time frames that can be so different. So I don't think Mike's wrong at all. I think he's very correct. And looking at kind of the macro, the bigger picture, I think that's spot on.
And Andrew, that's kind of the point I was trying to make is internals are great at finding the overall cycle. Now, again, if you're looking at a 20-day number of new 20-day highs, you're going to catch littler waves in there, and you're going to catch rotation, and that's a great environment for relative strength. And again, I'm glad the financials are starting to participate. I love that yields are bouncing here, thank God. But that broadens things out. But again, in general, the selling panic, buying panic thing is real, and it's every cycle. And usually the only cycle where we didn't have the first fall day was this last one because this coronavirus came out of nowhere. And thank goodness I'm on record with JC in March saying, this market's starting to look a little sketchy here. But we didn't have the fall day first, which was unusual because it was such an externality. So internals can work on the shorter time frame, but I really was stepping back to that one big call that people can do if you work as an accountant and you're just talking about putting your 401k in the market or out of the market. You really can do it with, I won't say little effort, but if you look at the tools from a bigger picture point of view, they're rock solid. Yeah,
I think it's interesting having kind of this group because you have someone like Willie he's working for a much larger institution. I mean, he's driving a much larger tanker of a ship. I manage tactical portfolios for high net worth families, so I have a little bit of mix everything. You have JC and you guys who are really kind of looking at it from a lot of different time frames. So it's kind of a lot of different perspectives because we're all wearing different hats.
Willie, I really like your chart showing the industry group percentage and uptrends.
Yeah.
I'd love for you to kind of explain that. What are you looking for here? How's this work?
Sure. So I break out the S&P 1500 into 75 industry groups, 25 large cap, 25 mid cap, 25 small cap. And I'm just looking at the overall percentage that are above their 10-week average, above their 40-week average, have a 10-week above their, or currently above their 10-week and 10-week above their 40-week. It's not, and then you aggregate it and you smooth it a little bit. It's not, it's not designed to be a timing mechanism. It's not designed to call little turns. It's designed to get a sense of whether or not beneath the surface you've got participation that is supporting what the index is doing. So that's one of the things that we looked at this week. We saw it continue to expand. It had expanded initially, then paused, and now is expanding again. Some of that is kind of what we've talked about, this rotation away from large caps and towards broader participation. That's picking that up. That's healthy from my perspective. I want to go back to something Mike said about not even looking for divergences in the first year or two of a bull market, and I think that's where breadth thrusts really come in handy, where you get that thrust, and there's any number of them that we can talk about that we saw this year.
Yeah, how do you define them?
Over multiple time frames. for me, the gold standard is getting 90% of the stocks above their 50-day moving averages. You see that gives you a tailwind for at least a year. And then the question is whether or not within that year you get another breadth thrust. And so within that year, the backdrop has improved. It's a tailwind. We can look at all the little turns and wiggles, but you've got that kind of, it's a wind behind your sails, even if you're not going exactly where you thought you were going to be going.
All right, I have a question. And this whole bringing the Avengers of market breadth into one meeting was completely selfish on my point. So when it comes to percentage of stocks or sectors or indexes above a particular moving average, 50, 200, whatever it is, these are things we ignore completely, no matter what. The only times we're interested in the percentage of stocks above their 200-day moving averages is not in uptrends, it's actually in downtrends to identify extremes, lows, bottoms. So we ignore all the percentages above smoothing mechanisms other than in downtrends to find extremes. I'm not saying that's right or wrong. That's just how we approach it. It is not a data point we are interested in at all. So I would love to hear because the moving average is always moving. So it's kind of hard for me. Like, I don't understand why I need to be concerned with why these stocks are above this particular line that's always at a different point. So I'm not saying I'm right or wrong. Most cases I'm wrong. I'm asking you guys, maybe, am I looking at it wrong? Am I missing something? Is there certain data there that I'm selling myself and our clients short by ignoring? Just would love to hear your thoughts.
Well, I'll go quickly if I can, because I use those tools a lot, JC, and I think they work and they're valid, but I also really like what you guys are doing with the percentage of stocks with their RSIs above 70. That's a great way to get a breadth thrust, and it's just another way to skin the cat. Katie and I tried to do that when we worked together years ago. We just didn't have the computing power at the time to do it. Now, I mean, you're literally tracking them on a spreadsheet or a
Katie Stockton,
marks.
for you guys.
Yes.
Katie Stockton.
Yes, I'm sorry. Great gal, brilliant gal, and love her to death. But we didn't have the computing power to do that. Now you can, which is great. So I'm used to using those older tools. But we talked about the selling climax with new 52-week lows and the buying climax with stocks above their 50-day. If you look at the percentage of stocks above their 200-day, there are good signals there. But again, about once every cycle. If it goes below 40, you're for sure in a bear market. I wait till it gets back above 40 before I give it the all clear signal, which happened on the 31st. So this signal was a little bit late. But if you go back,
hold on, time out. You wait for it to get back above 40% because we're looking for 15 or 20.
Yes. So this is a higher number, but it's a lagging, confirming indicator, not a by the bottom indicator. A really good one for that is if you look at the ratio of stocks making new lows to new highs, anytime that gets above 40-1, you're in enough of a selling climax to buy. And that one actually did not work during coronavirus. Worked great in 98, worked great in 2000, and great other bottoms. But if you can get 40-1, usually you're oversold enough to get some sort of bounce. But I think we had 8 or 10 days, which was a record of 40-1 ratio in new lows to new highs. Which again, different tools behave differently in different environments. And that's kind of the whole point of this discussion is which environment are we in and which tools do we start looking at? One other big rule I watch, which is dovetails on what you just said, is when I'm looking for divergences, I only look for divergences in the direction of the trend. So for example, if we're in an uptrend, I don't watch for an expansion of new lows, with the exception of looking for a fall day. But once I see the fall day, then I want to see new highs tail off. If we're looking for a bottom, I don't care about a surge yet. I look for the number of new 52-week lows to dry up as the market goes lower, because you want to see the group in charge start to give up their leadership and weaken. And so that dovetails to what you said just a minute ago about the perspective and the environment. And it absolutely is true. You're right on the money there. And I think you guys are right on the money in looking at the number of stocks, again, that fall to 30 on the RSI. Then you've had a ball day, And if you define it that way or you define it the way I do it, that's a fall day. And, short the first bounce, dude, because that's probably the market environment you're in.
Interesting. Willie Thrasher? Strazza?
Yeah. Would you guys say that we had a breadth thrust? I mean, a lot of indexes have gone sideways since January 2018. I know not the large cap indexes, but when we look at, like JC said, we don't look at the moving averages as much, but when we look at the percentage of new short-term highs and percentage of stocks that got overbought on June 5th, we saw very extreme readings. So would you consider that, a breadth thrust that would be the initiation phase of a new bull market, even though they're not the new 52-week highs, Mike?
So you're saying June 18th of this year, not June of 18?
No, I'm saying June 5th of this year.
Okay.
The Russell 3000 even, highest reading in over 10 years, percentage of stocks overbought. That was June 5th. Even short-term highs, they were double their level, whether you look at 63-day highs, 21-day highs, 10-day highs. They all spiked to double or even triple their levels that they were at when they peaked in January. And 63-day highs were higher than I have data for. So going back over a decade.
No, good point. So where I kind of really flipped to the bull camp is after we had the washout, everybody was looking for a test, myself included. When we had the number of stocks above their 50-day get up around 90%, that's it, man. No test is coming. Now, I believe, if I'm not mistaken, that happened more like May. But certainly early June, you were getting a lot of all clear signals. And that's when you have to just quit playing for a test because you're in a new cycle. And at that point, you're going to get some sort of consolidation like we just did where the S&P consolidated above its 200-day and kind of held, and a lot of things did.
Rotation.
Right. And so that's where every cycle gets different. Sometimes you usually rotate into financials first. We didn't rotate into financials first this time, but you know what? I bet it's coming now. The point is...
Bond market's telling you that.
It is. And the point is you had a bottom. So whether the bottom is, this type of bottom or that type of bottom, all the different cycles are slightly different, but we had a bottom and the rotation might be unique, but you had a bottom.
Yeah, I'm with Mike. I was firmly in the we will have a retest low. JC did that charity event, and you had all these technicians come on, and I think there's only but one that was not calling. I mean, every market history data point was saying we will have a retest low.
The question we asked, we made the math. It was actually Tony Dwyer's idea. Shout out, Tony. He said, let's do the poll and let's ask everybody and do the math where the math works out as a retest or not, right?
Yeah.
And it was about 70% said retest.
Oh, I thought we were in
full disclosure.
And thank God we're not.
Yeah, I was firmly in that camp, and so I wrote back then, okay, I think we're going to have a retest, but here are the 5 things that I laid out. If we see these develop, one was volatility getting below its 33 percentile. Once we see all these different things that, if these occur, these things don't occur in a bearish environment. So if we can check all these boxes, then we're probably not going to have that retest. I think they all find, I think the last one occurred in May. And so that's how my framework was I think this is going to happen, but here's the things that's going to prove me wrong. And,
right. So that's sort of the point about technicians, if I can add and do your job, JC. Look, we all have opinions and we have great educated opinions, but man, we're flexible too. And we let the market tell us what to do.
You better be flexible.
When it's time to change your mind, you got to change your mind. I was on the chart summit and I was the guy that thought we were in 1929 because of the breakdown in the CRB and the breakdown in yields. That was a huge deflationary input that scared the heck out of me. Thank God it doesn't look like it's coming, but we had to be flexible and change our mind. And that's the difference about technicians. I got to tell one quick Ralph Eckenford joke since I'm on air here. I'm the generation of technician between Ralph and all you young guys. And so it's my job to tell all the Ralph jokes. So Ralph's favorite joke is there's a CFA and a CMT at dinner. They're having steak at Morton's, and the CFA kind of knocks his steak knife off the plate, and it goes shtunk and sticks in his foot. And the CMT goes, dude, why didn't you move your foot? CFA says, I didn't think it'd fall that far. Ba-dum-bum.
And then the technician says, and then the fundamental guy says, why didn't you catch it for me? It's like, well, technicians don't catch falling knives.
Right. You get the idea. Or the CFA says, well, I'm buying dinner because none of you technicians actually make money and have jobs or something like that. We're all employed. But the point is, fundamental guys try and predict the market, and we at least react to it and move our foot when we have to move our foot.
Well said.
And then just to hit on like the international breadth right now, Willie, I think you made an interesting point earlier that you're seeing breadth deteriorate. I know that the short-term highs haven't been hitting as high of readings just based on our universe of international ETFs. We track about 60 of them. But when I look at last week's report, we had 85% of our international ETFs are in a bullish momentum regime, when as of June 5th, when the market last peaked, only 72% were in a bullish momentum regime. So I'm still seeing improvement. I don't know if that has a lot to do with the dollar tailwind or what. Maybe if you look at global indexes, it's different. But I want to know what you're.
It was the GDP report that came out. That's why.
But whatever, it's broadening, right? And this is the characterization of this cycle.
Yeah, I would just, I don't have a problem with international right now, and I think that's the next area that we're going to see leadership. I think we can talk about sector rotation, we can talk about global rotation. Yeah, and it's a minor. It's just a minor. If you look at the percentage of global markets above their 50-day averages, if you're not looking at that, you're not. Then you don't notice it. But when it's a little bit higher than where it is right now, is typically a more bullish environment. It's not a bad environment right now.
Right.
It's not and maybe that's the one of the lessons here is that, I mean, you're allowed to, you can have good environments, you can have bad environments, you can also have kind of environments.
Right.
It's not always black and white. Sometimes there's that in between where you just kind of stick it out because you don't have a good enough signal one way or the other.
Exactly.
Or you don't
the
go
second
into
year
it.
of a bull market. The second year of a bull market when you're just trending.
Yeah.
Like
So,
2017.
You got to give the
Right.
market time to catch up and breathe, right?
right.
Exactly.
Well, and that's the other. I think that's one of the points that people misconstrue through this environment. All right, you can have leaders lead. You have a problem when the followers are going in the opposite direction. Not necessarily if they're just not going as fast as what the leaders are doing. And so that's to the is it a divergence or is it just not confirmation? And I think that's an important distinction that needs to be paid attention to. Everyone looks at non-confirmation
Right.
and says, "Ooh, there's a divergence. Get on the other side of it." That doesn't work real well.
It just hasn't confirmed yet.
Yeah, right.
I classify kind of corrections or market downturns kind of in two different categories. One that's built on breadth, where you have just a deterioration, kind of we had in March, where breadth started to break down. And then you have ones that are built on sentiment. The ones that are breadth are much more severe. You have much larger drawdowns. The ones that are based off sentiment, just where things have gotten a little overheated, 5-10%. You kind of sweep out the weak hands, then you can continue on. And so then you kind of break up different type of market environments to where if you see sentiments getting overheated, but breadth still looks strong, then maybe if we do have a correction, and I'm not saying this is what we're right now, but that's how I kind of framework it, that we can have kind of short-term pullbacks that are sentiment-driven, and then you can have much more sustainable that happen a lot less. Like Mike said, you need to wait for it to really develop, that are more severe, that are more breadth-driven. And so kind of looking at what's really deteriorating right now. Is it breadth? Or is it more sentiment-driven market response?
All right. Thrasher just stole my thunder there. I was gonna.
Sorry.
I know this is like a breath conversation and everything, but you guys are way too smart for me to make it easy on
Not
you.
hardly.
Come on. So I'm gonna change the subject there for a second, and Thrasher just teased it up a little for me.
So welcome.
Let's talk about the sentiment. Let's talk about that. And I'll leave it to you, Thrasher. Tell me, what are you seeing? What scares you? What makes you excited? What makes you say, like Master P?
Yeah, so I'm about first job I wear is the portfolio.
Mike Hurley's
so
like, who's Master P?
My main job is managing risk. So I do watch sentiment. And so I was tweeting yesterday, the daily sentiment index for the VIX got down to 8% bulls.
So what is that? What is that? What is the daily sentiment index?
Daily sentiment index is looking at futures market. So it's looking at the sentiment of the futures market put out by Trade Futures, Network Press. It's been around since the 80s for some markets. But they're a proprietary sentiment gauge for all the different future contracts. And so right now you're seeing, and so when sentiment gets really high, is initially a bad thing. Similar to momentum, really high momentum just means there's a lot of buyers and it's a good trend. But for when I look at volatility, when we get something like an 8%, which is extremely, you don't see it very often, and we're starting to get some of the compression that I watch in volatility. I think we are a little bit, the market's up 50% off the March lows. That's great. I think sentiment is a little bit stretched right now. We kind of had that little 7% pullback in June. That was that one day kind of blow. I think we could see something else where it'd be very healthy to have a little bit of a pullback. We have that rotation you've been talking about. We get some new leadership. But sentiment right now, I think, is very interesting. When Portnoy is on the cover of every single magazine about his amazing stock pick, just anecdotally, just entertaining. But the question I would ask is, if we have the rotation, you've talked a lot about it, JC, is the different market environment we're in right now to where tech has become such a massive overweight. Can we really, at this point, rotate out of tech and that not have a negative implication for the overall market? Tech right now, the FANG stocks represent about a quarter of the S&P from a size perspective. Can we have that rotation you've been talking about, which I think I agree is playing out?
Think about this, right?
Yeah.
Think about this.
It's an honest question.
So think about it like this. If you're a hedge fund and you are super overweight tech, which if you haven't been, you've been losing, right? And tech puts up a 1%er in this month, or a 2%er, or a flat, or God forbid down 1 or 2%. And energy or industrials or transports more specifically put up a double-digit return, and you're not in that, that's a big problem. So the whole tail chasing in the institutional world with the massive dislocation from a sector to sector perspective, like that, not just regular sector rotation, but obnoxious rotation. Yeah. And Mike, I'd love for you to touch on that, because I know you talk to a lot of institutions, as do we. Like, that's a big problem in their world, right? Why don't we talk about that?
Well, the first thing I'd say is sentiment to me is something. Andrew does a lot of great work on it. And again, during our chart summit, he had a great presentation. And thank you for sending it to me. But to me, sentiment is a lot like the fall day, where it speaks about every 3 years, the VIX will blow out. And that's what's important to me, is when the VIX blows out and then gets below its 5-day moving average, I think a bottom is in place. Now, usually that bottom gets tested, but the VIX is something you really can't watch every hour or every day or every week unless you trade on a shorter term time frame. If you're looking for cyclical bottoms every 3 or 4 years, sentiment doesn't speak that frequently. I think you hit on one sentiment issue, though, just recently in your work, which was gold. Gold is so far above its 40-week moving average. It's seeing such heavy flows. But again, that's one of those signals that happens very infrequently. And those are the good signals in sentiment when they do that. So back to your direct question, I think it's true out there that a lot of people have been in the FANG stocks and neglecting some of the other stocks. And you are starting, I think you're going to see continued rotation into those. Now, again, that might hurt tech, or tech may underperform. But in general, it is a broadening of the rally when you see things like Progressive Insurance breakout, a lot of the industrials that are breaking out, Cummins, things like that.
Fucking Expeditors has done nothing for years, exactly. And now is breaking out.
3-year trading range, pop. So that stuff's really good and really healthy, and I think it's good for us longer term. With regard to the tech, though, gosh dang it, I had one point, but I forgot it, so I'll yield the mic. I'll butt in if I remember it. But in general, it really is good broadening of the bull market, and I think it leads you to believe that it's going to go further, maybe not just be led by those stocks. Oh, I remembered. This period reminds me, after you've had a peak in leadership or that first year of a bull market, usually you do follow into a trading range. We're in the time of year for a trading range.
At the index level.
At the index level. Underneath the surface, absolutely rotation, which is what you're talking about. If you look at the period of time between Brexit and when Donald Trump was elected, we went sideways, we ground lower for about 2 quarters. Frustrating market unless you were aware of the rotation underneath the surface. And then there was some great opportunity there. But I think that's the type of market environment you're in for the next quarter or two.
I think that's a great point. And I just want to like if we just made the assumption, and I know it's way too soon, but the seeds have been planted. If we do finally see that rotation into these lagging sectors, industrials, financials, energy, where they just have a lot more names, but a lot lower cap. I mean, people are arguing about breadth a lot right now. What happens if the FANG stocks stop participating to the point that the major averages are getting dragged on, but then industrials, financials, and energy materials start working? You're going to see breadth start to expand, I would imagine, in that situation. And the averages, like you said, Mike, are probably going to go sideways or even lower. And then people are really going to be like, what the fuck's going on?
Dude, material stocks. All right, let's get back to sentiment. Willie, talk to me about sentiment. You put up good charts. You're a big Ned Davis guy. Love the work that they do. Talk to me about sentiment, how you approach it. What are you seeing today?
Sure. So to Mike's point before, it gets overanalyzed. Ned Davis says you go with the crowd until it reverses at an extreme. Every little squiggle in sentiment doesn't matter. And in fact, if you're still, one of the things people don't realize, expanding optimism off of a bearish extreme is actually a bullish backdrop. It's people coming into the market, you go with that. I think we're getting to a point where optimism seems frothy from my perspective. You have low put call ratios. You have this morning the investors intelligence data. You have the fewest bears there since early 2018. Not as good a top signal as that is a bottom signal, but still evidence of increased risk. The other thing I don't like is that, so tie this into the big tech names, clients I hear from, or FAs that I hear from talking to their clients, are parking money in some of those big tech names as being safe places to, I can't think of anything else to do, so I'm just going to put it in Apple right now, like it's a money market fund. That speaks to sentiment and risk.
Thanks.
And what's going to happen next. So one of the contrary things.
Hold on. Sorry, I'm shorting the FANG stocks. Hold on 1 second.
Like your Robinhood account.
The other thing, the flip side of that is you still see outflows from a fund perspective, and we've seen them consistently over the past few years. But it's the few periods that we've seen inflows have been associated with near-term peaks. So I'm getting concerned about sentiment right now. I'd be much more concerned if we start to see ETF and mutual fund flows really move into equities again. That hasn't happened yet, but it has a feel like we're heading in that direction because everyone's kind of celebrating the fact that we're back to all-time highs.
What about the garden? How's that doing this summer?
So we have, this is totally not germane to anything, but we've got volunteer cantaloupes in the garden this year.
Volunteer cantaloupes? That's sick.
Have never planted them, but we put.
Is it ordered?
Is it a gourd? It's a cantaloupe, like a full-on cantaloupe.
But they're volunteering? Like, what are they volunteering to do? What?
They're
live.
They're growing. They're being.
I have no idea what those are.
Thrasher, it's a gardening thing. When you call them volunteers, that means they came from prior years. You didn't actually plant them this year.
I thought the court ordered them to do volunteer work.
Garden stuff, Thrasher.
Yeah, so we have like legit cantaloupes. We've got like half a dozen of them. So it's like the best garden year ever from my perspective.
Dude, I love it. I moved to California, and I figured, years ago, and when I'm like, okay, I'm going to move to California, I'm going to do California things, right? I'm going to do yoga. I'm going to start gardening. I love them both. Fantastic.
Well, we have been off the grid for vegetables for a couple weeks now, and it's the best thing in the world. I mean, you don't need to buy anything at the store, vegetables anyway, but it's a lot of green beans and a lot of cucumbers, but you figure out ways to be creative with them.
All right, Thrasher, tell me something not market related that is awesome.
I'm not allowed to leave the house, so I go to the gym and the grocery store. I work from my house. My wife just went back to school. She's a teacher, so she's been happy to kind of get back to school. A little nervous there, but it's good. We've had really great weather here in Indianapolis, so I'd say that's been really good. I'm glad that. I'm sad about college football. I'm still thinking about that. I really was looking forward to college football. So
Hurley, when we have our next chart summit out in the mountains, we're gonna do some double diamonds in the morning before the presentations, or what?
I don't know about double diamonds anymore, but
are you done with the doubles?
I might be done with the doubles. I might be on the old guy single diamonds or the blue square cruisers. But yes, I've skied my whole life, and I would love to be in the mountains with you, but we'll see how it goes when we get there. I kind of like to cruise now.
You're going to be the keynote speaker. So we need you safe.
Well, that's a wonderful invite. So I'll try not to break my leg, but thank you. I love being a part of all your events. You have a great crew here. It's great to speak with the two of you guys again. So thank you.
Strazza, any final words of wisdom for the folks?
No, selfishly, I'm just listening. I'm learning from all these guys.
Are we going to see S&P 4,000 or S&P 3,000 first? Sorry, had to.
3,000.
Thrasher. Who? Willie says 3? Willie says 3. Thrasher, 3 or 4?
I don't know. I honestly don't care. I'll just trade whatever it is. So price confirmation, that I'll add to the Willie thing. Sentiment matters, but until price confirms, it doesn't.
3 or 4? 3 or 4?
He's got 4. I honestly don't. I honestly don't care.
3 or 4? None of us care. None of us give a shit.
Three or 4 first. I'll say 3. I think we'll get something over the next couple of months. I will probably say 3.
All right, I say 4. So Hurley and me say 4. Willie and Thrasher say 3. Strazza, it's on you.
The tiebreaker.
You're the tiebreaker.
I think similar to the NASDAQ, how it just almost got back up to that 161.8.
Fibonacci.
Of the recent crash or drawdown in March. I think S&P eventually does the same, and that would put it around 41.
Woo! One up in us to 41.
I think we could go sideways for a long time before that happens, though, or correct a little bit. Again, if the NASDAQ corrected 10% from its current level, it would just be retesting February highs.
Nerd.
I think we'd all be buying it.
Listen, I appreciate all you guys being here. I respect all your opinions. Obviously, that's why we're doing this. So thank you. Cheers, guys.
And we respect yours. Thank you for inviting us.
Y'all have a good night.
Yep.
Thanks, guys.
See you guys.
So good. I'm OG, overly grateful for the chance to kill the beat, bro. Cain and Abel ain't trying to lay low, peep the shine.